Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Welcome back to the Working Wealth Podcast. I'm Patrick.
And I'm Trevor.
And we are going to continue our conversation today on insurance with a focus on life insurance. So if you have not looked at our last few episodes or watched those episodes, go back and get some baseline information there and join us back here for this episode. We're going to break it down, everything we have to talk about with life insurance.
Yeah, and stay tuned for the entire episode because we've actually run a couple scenarios with some real life data involved. So we're pretty excited to share that with you.
Yeah, we'll do that towards the end of the conversation. But yeah, thank you for that reminder. Appreciate that.
Yeah, of course.
So let's start out with just the conversation of life insurance. Like what is the purpose of life insurance?
Yeah, once again, insurance products are by function and by definition just taking risk and transferring it to someone else, risk that we can't take on. So when it comes to life insurance, we're basically taking the risk of losing life prematurely and having that income, lack of income coming in for our family to cover the necessary bills and the necessary expenses that we have in our lives.
Yeah, I think that's the most important piece there, right? It's like when you pass away prematurely, you can no longer provide, this might sound harsh, like useful value to your financial goals, right? Like you can't be making income and using that income to go towards those goals. So, a lot of people will sell life insurance for different reasons. They talk about debt coverage or, replaced income or investment opportunities in business situations. A lot of times we do buy-sell agreements, key man policies, that kind of stuff, which is all just that same purpose of how do we make sure someone's core function in whatever arrangement this is, whatever relationship this is, does not go sideways as soon as they're no longer here.
Yep.
Right.
Absolutely.
So thinking about that, quick statistic, right? And this is really, really important, is 54% of Americans, at least as of the past couple of years, don't have life insurance.
This is a really big deal.
Yeah.
Really, really big deal. This is one of the most critical pieces of coverage that we recommend to our clients, Patrick. You really should have life insurance, especially if you've got people in your life who depend on your income.
Right. Yeah. If you're married, you got kids, unmarried with kids, or in some cases, if you want to be married and have kids down the road, right?
Yeah.
Like it makes a lot of sense to have life insurance because the pricing of life insurance is predominantly based on age, gender, and health, right? So the older you are, the more expensive it is. If you're male, you're typically more expensive, and the least healthy you are, the more expensive it is. And I've had many, many scenarios in business, but also my personal life where I see people either just got insurance in place before they became uninsurable, or they had just gotten uninsurable before they tried to get coverage. And then we had to have some bad or like some pretty disappointing conversations around getting coverage.
And I think that's a big key piece of this conversation that a lot of people don't think about is the fact that you could become uninsurable at any time. We don't know what kind of medical diagnoses we're going to get, down the road in the future. So a lot of these policies are dependent on good health overall, not perfect health necessarily, but good health overall. If you've got a chronic illness or a critical illness, most of the time you're not going to be able to find life insurance coverage until it's too late. So we urge people, get it while you can, get it before something happens so that you've got it in place when you need it.
Yeah, exactly. And that is one of those things we touched on briefly in the last episode, talking about maybe some insurances to avoid is there are certain types of policies out there that are called guaranteed issue that serve certain purposes, right? Like the mortgage life insurance or other kinds of that nature. If you are uninsurable or the cost would just be extremely high because of your health at this point in time, sometimes looking into those guaranteed issue policies is going to be a better bet, right? But we don't want to start there. We want to start with traditionally underwritten policies, meaning you're going through a health evaluation, you're filling out you're maybe having like a medical test done or physical done to get blood draws, urine samples, things like that, because the insurance company is trying to dial in, hey, how good is your health? And if you're doing more underwriting, typically they can get better results to really identify how good your health is and then give you a good policy number. Yeah,
absolutely. And really, the number one life insurance that we recommend that people get is term life insurance.
Right.
And term life insurance is relatively inexpensive, especially compared to a lot of the other forms of life insurance that we're going to talk about later in this episode. It is a fairly inexpensive way for most people to get really, really great amounts of coverage on their family if the worst were to happen.
Yeah, I agree with that. So let's break down, before we go into all the different types of coverage or different types of policies, let's talk about the calculation methods. Because I feel like that's something too that gets a lot of confusion is, well, how much coverage do I need? And I just want to kind of start by saying the goal is not necessarily to have a specific amount of coverage for your entire life. The goal is to have coverage while you need it, for what you need. And then ultimately, if we do everything else right, we become self-insured where we have enough resources through investments, real estate, or other ventures where we don't have to have that coverage down the road, at least for just for the sake of replacing our income potential.
Exactly.
Over time. So can you walk through those first couple methods we have for determining your calculation method?
Yeah, absolutely. So there are a lot of different ways that you can kind of get a rough estimate for what you should put in place coverage-wise. One of the most common ones that we hear is kind of that typical just income multiplier method. This is the method that Dave Ramsey uses. He always says you need 10 to 12 times your annual income in coverage. So really, the income multiplier is as simple as that. You take your annual income and you multiply it by anywhere from 10 to 20, it depends on who you ask. And then that gives you a number. If you have a $50,000 annual income and you want to get 10 times that coverage, you would have a $500,000 insurance policy put in place. It's really that simple. Income multiplied by some sort of multiple to get to a final coverage amount. From there, we get a little bit more complex. And I actually really like this method. This is called the DIME method. And really what DIME stands for is debt, income, mortgage, and education. So it's an acronym for those 4 different big categories. Debt, you take a look at your financial picture and you evaluate how much consumer debt outside of your mortgage you have. So that's a set value, right? Let's say it's $50,000. You've got your income. This is another just kind of formulation of your annual income multiplied by how many years you think you'll need to replace that income. So you take those 2 separate factors. Those are set values. You then figure out how much is left on your mortgage. That's a set value. And then you kind of estimate how much, if you've got kids who are potentially going to go to college or need educational funding in their life, you make estimates for how much that's going to cost as well. So you take all 4 of those different amounts, you sum them up together, and that gives you an overall number of coverage that you need to put in place.
Yeah, perfect. So, and the reality again, right, with doing these calculation methods, we've got a couple more, is we're just trying to dial in what is an appropriate amount for now based on your current situation and what could be coming down the road, not to oversell, right? And also not to undersell, right? But just to make sure we actually have enough coverage for where we are today.
And I would say it's always better to have a little bit more coverage than you need than it is to have less coverage than you need.
Yes. Yeah, exactly. So next one is the income replacement method, right? Which is pretty similar to just the salary multiplier, the income multiplier, right? So you're looking at, hey, what is my annual income? And I'm going to divide it by 4% or 5% just to kind of essentially create a large nest egg that we can pull a safe withdrawal amount from on a regular basis if we were to pass away and invest those dollars. If you don't like the percents, just multiply it by 20 or 25, right? Like that's the inverse of that. So if I'm making $50,000 and I want to have a 5% withdrawal rate, that's multiplied by 20, that's $1 million, right? So if I did that math right, 50,000 times 20. Yeah.
How many financial advisors does it take to make simple math calculations? We don't know.
Apparently a lot.
More than 2.
Right. So we got income replacement method. That's a great option. And then the last one being human life value method. Explain to us the human life value method.
Human life value is very complicated. This is for your uber nerds out there that really want to get down into the nitty gritty of how much is money going to inflate? How much is the US dollar going to inflate over the expected amount of time I'm going to need coverage? It is really complex. Basically, the high level idea is you multiply your annual income by the number of years you need to replace. Then you take the present value of money and you make assumptions on inflation over time, and then you use those inflation assumptions to get other calculations for how much money you're going to need, and then you take withdrawal rates. It's very involved, but essentially there are online calculators that you can use to kind of really dial in this calculation. It takes a lot of the calculation work from you and puts it on the computer side of things, which is nice.
Yeah.
But
it's complex.
It's very complex.
It's not worth the time.
Probably too complex for what you really need.
Yeah. And that's why we always start with just, hey, like, what is a multiplier of your annual income?
Yep.
Because for most people, if we're, again, we said this a lot in this series, if we're doing the right things, we're going to be eradicating debt, building savings, building up investments. Your situation will be enhanced over time to where you won't have as much of a need for this. Therefore, we don't have to be as precise right away.
Yep.
Like, I don't need to know that because of a 2.9% inflation rate and an assumed 9.3% investment return over the next 17 and a half years that I'm going to need down to the penny an amount of life insurance. Because we say this to people all the time is, once you get that initial plan established and build a foundation, sometime in the next 6 weeks to 6 months, your life's going to change and your plan's going to need to be updated. So for that very reason, we don't need to spend as much time going into that. Right?
Yeah.
Now, if we have a tremendous amount of complexity, yes, approach the planning process with an appropriate amount of response to that. But for most people, 10 to 12 times your income or even the dime method, that's going to get us a sufficient amount of coverage, or we can just move on to the next thing of building wealth from there.
Absolutely.
So you already kind of touched on this a little bit earlier, but I think it's important that we really kind of break down this next component, so we talked about the purpose of life insurance. We talked about, the different ways to calculate coverage. Now let's talk about the actual products.
Yes.
And when we think about the product lines, there's really two primary categories for the products. You have term and permanent. Right. And I think it's important when we talk about any kind of financial concept to actually understand the words we're using. So if we talk about permanent, that means the way it's designed, if it's executed properly, this coverage will be in place permanently. Right. Ideally, like till you die at whatever age that is. On term, we have coverage in place for a term, like a period of time. And for us, this goes back to the understanding or the assumptions we've already mentioned a few times, which is life insurance, like the need for life insurance should not be a permanent need. If we're doing other things right, we should not have a need to replace income when I'm 77 years old or 93 years old, right? Now, if we still have coverage in place or we decide to buy coverage to be in place at that point in time, that should be more of an estate decision or a tax planning decision, something like that, but not a core function of just replacing lost income.
Yep, exactly. And that, at the essence of what the coverage is intended for, is really what we would recommend for people. It's income replacement. If you're 90 years old and you're, drawing Social Security and you've done, everything well up to that point, you don't need to replace your income because likely you're already set.
Right. Exactly. So we think about that, like, let's talk about term first, and then we'll go into permanent, the different types. So term is pretty straightforward. It is pure insurance. It's just like your auto insurance. It's just like your home insurance. I'm paying a fixed premium for a fixed amount of coverage for a fixed period of time. A lot of people don't think about that, right? If I pay for my auto insurance every 6 months, I'm buying a 6-month policy for that coverage. If I'm paying for my home insurance, I'm buying a 1-year policy for that coverage. Same thing with the term insurance. I might buy a 10, 15, 20, 25, 35. I've even seen 40-year policies you can buy now. I'm buying a specific amount of coverage with a fixed price for a fixed period of time. There are different types of term. The one that we recommend all the time is fixed, right? There's annually renewable, there's adjustable, there's, annually increasing. the gist is like, let's lock in our price and give ourselves the freedom to use our other discretionary income for wealth building activities.
Absolutely.
And I think you have to understand what term is, because every other policy is actually built on a term chassis.
Yeah.
And people don't think about that, right?
Just a longer term.
Well, you'll get into debates around, well, like term versus permanent, and people don't realize if they're just purely advocating for permanent all the time, well, it's just a really whooped up, expensive term policy is what it is.
Exactly.
So that's term. You're paying a fixed premium typically for a fixed amount of coverage for a fixed period of time. Permanent goes by a lot of names. And when I first got in the business, we used to joke around like, the longer the name, the more complex it sounds, the more expensive it is, and oftentimes the worse it is for the client, right? And as I say that, I also want to kind of press pause and repeat what I said earlier, is every product has a place, but if we misuse products, we cause more harm than we cause good. And that's why for most people, like well over 95% of situations, pure term is the way to go for us, right?
Absolutely.
I can actually say I've never written a permanent insurance policy because it has not made sense in 9 years of business.
I'm very proud of you, Patrick. So. That is a big accomplishment, especially in an industry that pushes permanent life constantly. Yeah. I mean, that is...
Not saying I haven't quoted it out, right? Because I'm all for pros and cons. Let's see the cost benefit. Let's do the analysis. And then the client decide from there.
Yeah,
right?
Absolutely.
But let's go through just like high level, the names of these different types, like the most common types, and then let's do definitions for each of them.
Yeah, absolutely. So really, we're going to kind of talk about 3 to 4 main types of permanent insurance today. Really, everyone's heard of this one, whole life insurance. That's one. Another one is universal life. There's also indexed universal life. And then finally, there is variable whole life insurance. So those are kind of the 4 main, categories and topics that we're going to talk about today. They all have slightly different functions and slightly different, levers that you can pull. In essence, they're all permanent life insurance. The coverage is intended to start from the time you buy the policy all the way through to your death. Yeah.
And the way that they actually do that is, like I said earlier, all of these policies have a term component built in, but these permanent policies also have a cash value component, right? So permanent, sometimes called cash value. You have basically a product that's a combination of insurance and an investment. And I'm using investment with air quotes here, right? So the whole life, you have a annually renewable term policy with a savings component with a guaranteed rate of return, right? So like if I pay a premium on a monthly basis, quarterly basis, annual basis, part of that premium payment goes to pay the policy fee, part of it goes to pay for the actual insurance, and then part of it goes into a savings account that I can then access down the road by taking a policy loan or by surrendering the policy. The important thing about this is like I've mentioned, every one of these policies has a term component. That is a annually renewable term, meaning the cost of insurance goes up every year as I get older, which means more of my premium goes towards that over time, right? Versus just buying a fixed policy. So typically with a whole life policy, your premiums are not going to change. It's based on like how long you want to be paying into it and what the coverage amount is, your age, all that stuff. That will determine the cost of the policy. But you're going to have that fixed premium for the fixed guarantee, ideally for your entire life, right? Typically, the whole life is going to be your most expensive option as well, because there are so many guarantees built into it. Anytime you're trading dollars for a guarantee, it's going to cost more money.
Absolutely. Right? There's a guaranteed cash value table that these policies will demonstrate and show as you're buying them. And you can actually see what the cash value is going to be over a 30, 40, 50 year amount of time.
Right.
Great.
Yeah, and that's something too. I'm glad you said that, because as we get into the other types, anytime you're looking at a sales pitch or an illustration, a lot of times the sales agent is going to want to talk about the illustrated values, like the current rates or the most recent time period rates, not the guaranteed rates historically, right? Guarantee is the only thing you can really sell on, because at the end of the day, if things go sideways, the guarantee is the guarantee. Nothing else is guaranteed.
Absolutely.
So that's whole. Variable is a little bit different. Same overall structure, but instead of that money, like the part of the money that goes into the savings account, going into a fixed return, that is actually going into a investment style bucket, right? So it's actually a separate account. or I was actually about to use that term. It's a separate sleeve of the policy, right, that gets invested into something called a separate account, which is very similar to a mutual fund, right? There's a lot of different mutual fund structures out there or separate account structures out there. Depending on the company you're using, they might have certain selling agreements to use different companies' products inside their policies. But the gist is with the variable, you're going to get market-like returns, or you have the opportunity to get market-like returns, which means your premiums will probably be the same, but there's no real guarantee on the death benefit. Or there could be like a base guarantee, and then everything will fluctuate from there, up or down.
Absolutely.
So that's whole. Variable is like whole, but just with market movement instead of a fixed amount of return. Universal. So universal, I would say, is probably the most flexible, right? And by the name of being universal, that's kind of what it is. There's a lot of different things you can change. Sometimes it's called flexible premium adjustable life. I've seen that many, many times. But that universal is you can change the premium, you can change the death benefit, and the growth depends on different interest rate structures built inside the policy over time. It is a lot more flexible, but you don't have all those guarantees, right? So you can change the death benefit on the fly. You can change the premium you're paying on the fly. Usually for all these policies, there's going to be a minimum required like maintenance premium. So like if the policy is designed and I need to pay $500 a month of the policy, maybe the minimum maintenance premium is like $125 a month.
So you're never going to be able to pick all those, different functions and get a premium that's lower than that.
Exactly. Or if you do, you're going to immediately be eating into the cash value, and the policy could ultimately self-destruct from there.
Absolutely.
Break down the IUL compared with the universal for us.
Yeah. So this is essentially just an indexed version. We think of indexed investing. You're buying you're not buying specific active funds. You're buying an index. You're buying a tracking agent of. There's an index that sets a standard, and we're buying something that mimics that. So it
with certain restrictions on it.
With certain restrictions, exactly. These usually have a 0% floor. So you typically in the IUL policies aren't going to lose cash value or lose death benefit based on market returns. So even if the market has a really bad downturn, you lose 10% in a year, you're typically not going to be exposed to that loss. And that's kind of the big draw to these policies. You're going to be capped kind of at a 0% minimum or 0% floor on your returns. But on the other end of that, if you've got the IUL policy, and let's just say the market returns 15%, typically there are these caps, these wonderful return caps inside of these policies. So even though the market returned or your index returned 15% that year, your policy might have capped you at 6% or 9% growth. So you're not going to get exposure to that full benefit.
Right. Yeah. And we see a lot of times, especially today, there's people out there that are trying to sell a product to make a buck. There's a lot of very sleuthy marketing tactics going on out there because people are also selling these as like a tax-free retirement vehicle, right? And the reality is, yes, you can access some of the cash value that builds up over time in a tax-free capacity, but that is not the most efficient way to have a tax-free retirement. And a lot of the very predatory marketing tactics that are out there is trying to convince people to cash out their traditional retirement funds like 401ks, IRAs, things like that, and then go and buy an insurance policy. Well, for the insurance agent, that's great. If I get you to cash out a $500,000 401k and come and buy a $500,000 paid up policy, I might make $50,000 in commission. If it's a 10% commission, which is very, very common, right? But what that's doing is that's actually hurting me because I don't have full flexibility in my funds. It's not actually going to grow like the market. And we could get a whole lot deeper into this whole structure.
You're losing a lot of flexibility and a lot of potential growth.
Out of a fear-based decision.
For a guarantee.
Exactly. So one thing I kind of glossed over that I want to go back to is, we talked about these policies have a built-in like annually renewable term component, and they have a savings vehicle inside of it. The way that these policies are designed to be permanent is we know that the cost of the insurance on that annually renewable term is going to go up every single year. But if my premiums stay the same, eventually the cost of that insurance will go above what my annual premiums are. And unless I increase my premium payment, I don't have enough money going in to keep the policy in force.
Yep.
And that's ultimately where the savings vehicle comes into play. Once I get over that inflection point, now I keep making my premium payments, and I start drawing money down out of the savings bucket to actually cover the expense of the policy.
Yeah. And a lot of people don't know that when they're going into these policies. They don't know that 20, 30 years down the road, when my premium is actually more than what I'm paying in to pay for the insurance, the cash value that they guaranteed for me is actually going to start decreasing to pay the balance each month or each year.
Yeah. And I've, in 9.5 years of being in business, I've seen many policies that people had. Like, the reason why they're reaching out for help is they get a letter in the mail saying, hey, I have this insurance policy and it just lapsed, right? And I need to get life insurance in place. And I don't understand why this happened. When we start digging in, we figure out, well, this policy was maybe designed with a premium of $300 a month. And after 3 or 4 years, because you weren't seeing any growth in the cash value, which is very common in the first several years, and because you were like life changed and just your budget couldn't afford it anymore, like, you're like, well, hey, I just need to reduce this down. I go down to the guaranteed minimum, maintenance premium. Maybe in that case, it's $75 a month. Well, eventually I get old enough to where that $75 a month I'm putting in is not enough. And then the cash value starts eating away the little bit of cash value I accrued in those first few years, and the policy just disappears. Or a lot of times it's just people buy things out of fear or emotion, which we talked a lot about before. And then once they kind of get level-headed about it, like, oh man, like I shouldn't have done this, and I have this obligation of $300, $400, $500 a month for this policy. I really can't afford it. I just need to cancel it, right? So the best designed product or the best designed solution for a problem is only as good as our ability to execute and stick with it over time. And that's where we see a lot of people fail in this situation.
Yeah, absolutely. No, that's well said. And it's unfortunate because a lot of the people that are selling these products don't give you any of this information up front. They're pushing the the benefits of the cash value accumulating over time, and they're talking about having coverage for the rest of your life. They're giving you all the benefits of the product, and they're not giving you any of the real details about what could happen down the road given XYZ circumstance, or given the fact that the premium is going to go up each year. They failed to mention that. And that's what's unfortunate with these policies, is that they tend to be bought out of fear or out of misleading information, misguided information.
Yeah, exactly. So I think it is worthwhile to give some kudos, or like give some of the pros, right? It's like some of the pros of these policies is you can, if the policy is designed right and you make the premium payments, you can have coverage in place for your entire life. That's a very, very real thing. And I have had a handful of situations over the years where someone comes to me where they have a variable policy or universal policy that was funded well early on, and the market did really, really well for them. And now they actually have a large amount of cash value that they can access. In some cases, that's been a tax-free opportunity to buy a car with cash instead of getting a loan, or to give themselves a loan for starting a business, things like that. But those are very few and far between for the average family. So we have to be cautious around those expectations. But even in those situations, like, it was good funding up front, and after 3 or 4 years, they reduced down to the maintenance premium, and the market just took off with the returns on those variable policies specifically. So, as much as the sales pitch might sound good, understand again that guaranteed table. That's gonna be the most important thing.
And with the cash values, a lot of these policies have clauses inside of them that say if you take the cash value out before a certain time, you actually have to repay that back into the policy with interest most of the time.
And that's actually the concept that you see kind of floating around a lot on the internet of, be like the Rockefellers, right? Like that's the whole thing is, live life like the Rockefellers, which is the whole be your own bank philosophy, right? You're creating your own cash value resource that you can then borrow from that policy at 5, 6, 7, 8, 9% interest to pay yourself back. But what people don't forget about is, like, we still have to be making premium payments typically during that time. So, and if you look at the numbers of how much money I have to pay in
to get that
to
benefit.
get the cash value and
Yeah.
how many years I have to pay in. Typically, it's the first 3 years you have zero cash value
Yeah.
accumulated.
Yeah.
You have to be really invested in this policy, like emotionally, to stick with it that long
Yeah.
to even consider being able to use that as a resource.
Yep.
When I could just buy a term policy and save up or invest dollars in a brokerage account and have free use of those funds.
Yep.
Which, by the way, you can actually borrow against a brokerage account in a lot of places.
Yeah.
So you have that same option,
Yep.
right? Another thing I think is important is these policies typically do have multiple death benefit options. Most commonly, you have an option A and an option B,
Yep.
right? And option A is typically you get the stated death benefit or the amount of the cash value, whichever one is more at the time of death.
Yep.
I've never seen an option B checked. Out of all of the policies I've looked at over the past 9.5 years, not once have I seen option B checked.
Yeah.
And what is option B? Option B is you get the death benefit and the cash value.
Yep.
So I'm not going to like presume that there's nefarious things happening here, but I'm just saying like there's a policy feature that's there that could benefit the client in 100% of situations. And I've never seen that one selected.
Mm-hmm.
And anytime you ask, I ask a client about this, say, hey, like, here's what your policy says. And the definitions are in the policy document, right? It's not like it's hidden, right? Yeah. I always say, hey, did you know this was an option? Well, no, like that sounds like a great deal. I'm like, it would be, but you checked option A. Did you check option A? No, nobody brought that up to me. What's going on here, right? So it's important to understand, you know, again, like every product has a place. It has to be designed appropriately to actually benefit you.
Yeah, absolutely.
Over time.
And I think the option A, option B scenario is difficult because a lot of people are under the impression that they are going to, you know, benefit their family with the full face amount of the death benefit and all the cash value inside of their cash value account.
Mm-hmm.
And unfortunately, a lot of the time that is not the case. You're going to trade one for the other, whichever one's larger, your family's going to get, but the company that sold you the policy is actually going to retain the rest. So definitely seeing that option, the overwhelming choice in these policies, and talking to clients who had no idea that they even had an option to have both of those benefits, that is unfortunate.
Yeah.
Yeah.
I agree. Well, cool. That's a lot of information.
Yeah.
I think we switch gears.
Yeah, absolutely.
And let's actually look at a case study.
Okay. Sounds good.
You got the numbers?
Yeah, I do.
Okay. So just for reference, we actually ran some numbers on myself.
Yeah.
To get some quotes of comparable term life insurance options and a whole life option, right? Because we wanted to see, hey, what's like the most expensive, what's the least expensive, and then if we were to look at just buying the whole versus buying the term and investing the difference, how does that break out?
Yeah, absolutely. So I'm going to throw a lot of things at everyone right here. I'm going to try to keep it as simple as possible. We made a lot of different assumptions here. We had a lot of different scenarios. I don't want to overcomplicate it. Really, the main thing that we did is we looked at a 20-year term policy, a 25-year term policy, and a 30-year term policy versus a whole life policy set for the same term. Yeah. So if you bought a whole life policy or a permanent life policy and you held it as long as you had that term policy at 20, 25, or 30 years, what would be the outcome and the difference in kind of the cash value that you would accumulate in a standard policy, actually the policy that was fit directly for you, Patrick, versus kind of taking the difference in the premium. So the premium price of the permanent life versus the premium price of term life, taking that difference and investing it in the market. Now, with the investment assumptions, we did assume a 9% rate of return. Obviously, we could see different performance over that time period. But if we look at historical averages of the S&P 500, returning anywhere from 10 to 12% annualized, 9% we felt was a pretty conservative estimate.
Yeah. And I'll clarify one thing. So so we're looking at like the cost difference of the 2025 and 30-year term for me. These are actual quotes from real companies.
These are 100% real.
And that is compared against a whole life policy for the same death benefit, assuming I pay the premiums over my entire life.
Yes.
Right. So we're not looking at like a 20 pay, a 25 pay, 30 pay. That's some terminology of like you can pay a whole life policy, like pay it up in 20 years. That's going to be a much higher premium payment on a monthly basis to have the coverage in force for your entire life. We're not talking about that. We're talking about the entire lifetime stretch, like the lowest cost of the higher cost insurance,
Yep.
right?
Absolutely.
Compared against the straight term.
Yes, thank you, Patrick, and that's super important. It is taking the assumption of paying this whole life policy out for the rest of your life.
Yeah.
So really, we can start anywhere we want to. I think we'll save the really big, juicy difference in numbers for the very end.
Okay.
But I think maybe one example from the 20-year term, one example from the 25-year term, and one example from the 30-year term would be good. So
sounds great.
I'm going to start with kind of the least amount of difference. So I'm going to run through the 20-year term versus the whole life policy for a $250,000 death benefit.
Mm-hmm.
All right. So in this scenario, your monthly premium for the term, the 20-year term policy would be $13.69 on every month. The premium for the whole life policy for the same amount of coverage would actually be $233.20. So that is a $219.51 amount difference monthly.
$220 difference.
$220 difference.
Yeah.
Exactly. Okay. So $220. Go ahead.
No, go ahead. Yeah.
No, I was just going to say $220 different for $250,000 a policy, which for most people is probably not going to be enough insurance to start with.
Yeah, it's definitely not enough today.
Yep.
Yeah.
Yep. So if you took $220 and you had your term life in place for $13.69 a month, and you invested that each month for 20 years, you would actually end with $89,924, assuming a 9% annualized rate of return.
Mm-hmm.
The cash value in the whole life policy over that same 20-year period would be $56,683.
So $30,000 in the positive.
Yep. So that is actually a delta of. I'm getting confused here. Okay, sorry. Let me backtrack. It'd be $146,000 at a 9% annualized rate of return with the difference invested versus a $56,000.
Oh.
Yeah.
Okay.
So it's even better.
Yeah.
With a $56,000 cash value in the whole life policy. So that's an $89,000 difference, almost $90,000 difference over a 20-year term.
Difference. So like to me, the big picture there is I had the $250,000 in place for 20 years.
Yep.
At the end of the 20 years, I no longer need the insurance, but I have $140-something thousand in cash.
Exactly. And you have $90,000 more than you would have had in cash value in the whole life policy.
Insurance. Yeah.
Yep. Absolutely.
Gotcha.
So sorry, that is what we're going to do. We're going to break it down for each of these terms. So we'll kind of bump it up. So that's the lowest disparagement between the two policy types.
Yeah. Okay.
Next, we're going to go to a 25-year term with a $500,000 policy in place. Okay. So your monthly premium for the 25-year term policy would be $32.83 a month.
Okay.
Your whole life policy would actually cost you $453.20 for that $500,000 of coverage.
Oof.
So that's a difference of $420 and some change a month.
Yeah.
If we took that and invested it over a 25-year term, you would have $471,000 with an assumed 9% annualized rate of return. Your cash value would only be at $148,000. So that's a difference of $322,000 in a 25-year period.
That's wild.
Yeah, absolutely.
Absolutely wild.
And finally, this is the big one.
Yeah.
Let's look at a 30-year term policy with $1 million of coverage in place versus a whole life over those 30 years. The monthly premium for a 30-year term would be $65.78 for you, Patrick.
Mm-hmm.
For a whole life policy, it'd be $884 a month.
Ooh.
Yeah. It's a difference of $818 and some change.
That's like the average car payment today.
Yeah, absolutely. If you were to invest the $818 difference over a 30-year term, you would have almost $1.5 million if invested at a 9% annualized rate of return.
Just the difference of those premiums.
Yep.
Over
just
30
the
years.
difference. Just the $818 a month invested over 30 years with a 9% annualized rate of return, you'd have almost $1.5 million. The cash value after 30 years in a $1 million policy would only be $381,000. It's a difference of $1.17 million.
Wow.
Yep, absolutely. So as you can see, massive differences between term and whole life when it comes to if we take the dollars and put them in a more useful place for our financial futures, what we can actually accomplish.
Right. And I think one of the important things too here is like to point out that go back to the death benefit options, right?
Yeah.
So if I die the last day before my 30-year $1 million policy goes away, my family gets $1 million death benefit tax-free.
Yep.
And the
$1.5 million.
almost $1.5 million, right? Versus I could just have the $1 million death benefit from the whole life insurance policy.
The whole life policy.
Maybe, let's say my agent chose option B and the price didn't change for that reason, right?
Yep.
So now they get $1.38 million.
Yeah.
But that's still different from 2.5 million.
Exactly.
Yeah.
One of the interesting things too that we did with your policy, Patrick, inside of the whole life was we actually looked at the internal rate of return. So we looked at the actual, annualized return that you're getting in the cash value account inside of that policy. And what we found was that the guaranteed rate produced a 2.9% IRR.
Okay.
The dividend reinvested, the projected this could be the value of your cash value side of things, yielded a 4.9% annualized rate of return. So when you compare this to average market returns over the last 100 years, these are pretty bad returns.
Yeah, it's not great.
Not great at all.
Well, and to me, like I think a lot of people would want to argue the returns.
Mm-hmm.
Like I know that a lot of people. I've had these conversations, people selling these policies where they talk about, but the dividend pays back and it helps reduce your costs or it buys up more insurance or whatever else. And I'm like, well, that's great, but I don't have liquidity.
Yeah.
Right. It's like, whereas if I have the term policy and then I also have the investments, I have the full liquidity.
Yep.
So to me, it goes back to, again, like what is the right tool for the situation.
Exactly.
But I think for the average American family, like for most people, have the flexibility to have the liquidity with better returns.
Yep. Pay $65 a month for $1 million policy and have a bunch more money to actually build towards your goals.
Right. And even if like the internal rate of return with the dividends is 4.9, all that means is I need to make 6%, from the other option, which is a really, not great balanced portfolio return.
That would be a horrible return in the market over a 30-year period.
Right.
We're all in trouble if that happens.
We're all having a hard time, right? But even still, I get to double dip.
Yep.
Right, because I would have the investment dollars and the death benefit, even with the 6% rate of return versus the 4.9 on the cash value that I really can't touch without sacrificing the policy.
Absolutely. So really interesting. When I was crunching these numbers, I was absolutely shocked that the disparagement was that wide, that there was that much difference in the investments and in the outcomes over a 30-year period.
Yeah. It's one thing to like hear about this and talk about it with people, but then to actually like run the numbers. And we actually ran the quotes, right? Like we talked to our case manager and figure out, hey, what are the different companies? What are the different prices? We didn't cherry pick like a high price. This is actually probably one of the lower priced ones in terms of the whole life and for the term.
And then, for the term and the whole, we went with just normal average options. We didn't exactly like you say, cherry pick the most expensive whole life policy versus the cheapest term policy. We did not do that. This is mano a mano on both sides. And the results speak for themselves.
Yeah. Awesome. Thank you for doing that. I appreciate that, Trevor.
Yeah. Sorry, everyone. That was probably a little confusing, but the main picture is you can make a lot of money if you just take the difference in a whole life versus a term life policy and invest it over a long period of time.
Yeah, that's right. Fantastic. Well, we covered a lot of details here, right? We had some education, some basics, some foundations, and some real numbers in a case study here. We've said it many, many times. The whole point and the reason why we're doing this is we want to make sure people have education, they understand what their options are, and can make the best informed decision for their personal goals and their situation. So if you guys have questions and you want to evaluate what is the right thing for you, reach out to someone you trust. If you don't have someone you trust, if you don't have an advisor already, reach out to us. We'd be more than happy to have that conversation and help you really understand what's the right solutions for your family over time.
Absolutely.
And I guess with that said, if you have more ideas for questions or comments, concerns, things like that, let us know as well. And we'll be happy to put that into an episode coming up soon. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.